Hello dear students, welcome to the video. Today we are going to learn personal financial planning and specifically chapter 2, investment planning. This chapter is part of MBA third semester SPPU syllabus, and it is not only exam important but also extremely useful for real life money decisions. So let's understand this chapter in a simple, practical and exam oriented way. In this video, we will understand what investment planning means, why it is necessary, different investment options available in India, mutual funds and SIP, commodity markets, portfolio creation, and awareness about mis-selling of products. After watching this video, you will be confident while writing answers in exams and also while making personal investment decisions. So let's start. Investment planning is necessary to achieve both short term and long term financial goals. Short term goals can be education or marriage, and long term goals include retirement and wealth creation. Through proper investment planning, we can manage our income and savings in a systematic manner. It also helps in controlling financial risk and in beating inflation, which otherwise reduces the value of money over time. Now, moving next to the characteristics of a good investment. First is safety of capital. Protection of principal amount is always the first priority. Second is reasonable and stable returns. Returns should be consistent and aligned with the risk taken. Third is liquidity, which means the investment should be easily converted into cash when funds are required. Next is tax efficiency. A good investment should help in reducing tax liability and improve post tax returns. Another important point is risk matching with investor profile. The level of risk should be suitable according to age, income, and risk tolerance. Finally, suitability to financial goals is very important. Every investment should be linked to a specific financial objective. So, investment planning helps in choosing the right investment for the right goal at the right time. Non-financial assets are physical or tangible assets which have real and visible existence. These are assets that can be seen, touched, and owned physically. Now, let us understand what types of assets are included under non-financial assets. First is real estate, which includes land, residential property, and commercial property like shops and offices. Second is physical gold and silver, such as jewelry, coins, and bars, which are traditionally preferred investments in India. Next are commodities, which include agricultural products and other physical goods. Another category is precious stones, like diamonds and gemstones. Apart from this, non financial assets also include art, antiques, and collectibles, which may have high value over a long period of time. Now, moving next to an important feature of non financial assets. These assets provide protection against inflation because their value generally increases when prices rise in the economy. However, these assets usually have low liquidity, which means they cannot be easily converted into cash whenever money is urgently required. So, non financial assets are good for long term value preservation, but they may not be suitable for short term financial needs. Financial assets are paper based or digital investments. They do not have physical existence, but they represent financial value and ownership. These assets are mainly used for wealth creation, income generation, and long term financial planning. Now, moving next to the classification of financial assets. Financial assets are broadly classified into two categories. First category is market linked products. Market linked products include equity shares, equity mutual funds, exchange traded funds or ETFs, derivatives, and ULIPs. In these investments, returns are directly linked to market performance. Higher returns are possible, but risk level is also comparatively higher. Now, next is the second category, which is fixed income products. Fixed income products include bank fixed deposits, public provident fund or PPF, national savings certificate or NSC, bonds, debentures, and post office savings schemes. These products provide stable, regular, and predictable returns and are preferred by investors who want safety and income stability. So, financial assets offer different options for different risk profiles, and proper selection is very important in personal financial planning. Debt instruments are investments where an investor lends money to the government, banks, or companies in return for interest income. In simple terms, you are acting as a lender and you receive fixed or regular returns. Now, let us understand common types of debt instruments. First are government securities and treasury bills, which are issued by the government and are considered very safe investments. Second are corporate bonds and debentures, where companies borrow money from investors and pay interest for using that money. Next are bank fixed deposits, which are widely used and provide assured returns. Another important category is public provident fund or PPF and EPF, which are long term savings instruments with tax benefits. Debt instruments also include debt mutual funds, which invest mainly in bonds and money market instruments. Apart from this, post office savings schemes are also popular debt instruments providing safety and steady income. Now, moving next to the key feature, debt instruments carry lower risk compared to equity investments, but returns are also relatively moderate. So, debt instruments are suitable for conservative investors and for maintaining stability in an investment portfolio. Investment in mutual funds in India follows a simple and systematic process. First step is completion of KYC formalities. KYC means know your customer, which is mandatory before starting any mutual fund investment. Next step is identifying financial goals and risk profile. An investor should clearly understand whether the goal is short term or long term and how much risk can be comfortably taken. Now, moving next to selecting suitable mutual fund schemes. Based on goals and risk level, investor can choose equity, debt or hybrid mutual funds. After that, investor needs to choose investment mode. This can be either lump sum investment or systematic investment plan, also known as SIP. Next step is investing through proper channels. Investment can be done using AMC websites, mobile apps, banks, or authorized mutual fund distributors. Finally, regular review and monitoring of performance is required. This ensures that investment remains aligned with financial goals and market conditions. So, mutual fund investment becomes effective when it is planned properly and reviewed regularly. The structure of a mutual fund consists of different important participants. First is the sponsor, who promotes and establishes the mutual fund. Next is the trustee, who works in the interest of investors and ensures that the mutual fund operates properly. After that comes the asset management company or AMC, which manages the fund, takes investment decisions, and handles day to day operations. Then we have the custodian, who safely holds the securities on behalf of the mutual fund. Finally, the most important part is the investors, who invest money in the mutual fund schemes. Now, moving next to the advantages of mutual funds. One major advantage is diversification, which reduces risk by investing in different securities. Second is professional fund management, where experts manage investments on behalf of investors. Another advantage is liquidity, as mutual fund units can be easily bought or sold. Mutual funds are also affordable because investors can start with small investment amounts. Now, moving next to performance evaluation of mutual funds. Performance is assessed using absolute returns, which measure total return over a period. Another method is CAGR, which shows average annual growth. Performance is also compared with a benchmark index to judge relative performance. Finally, risk adjusted measures like Sharpe ratio help in understanding whether returns are adequate for the level of risk taken. So, mutual funds combine structured management, multiple advantages, and transparent performance measurement. Now, moving next to systematic plans in mutual funds. First is Systematic Investment Plan, commonly known as SIP. SIP allows investors to invest a fixed amount at regular intervals, such as monthly or quarterly. It encourages disciplined investing and reduces the risk of market timing. Next is Systematic Transfer Plan, also known as STP. STP helps in systematic transfer of money from one mutual fund scheme to another, usually from debt fund to equity fund. This helps in gradual market entry and better risk management. Now, next is Systematic Withdrawal Plan, commonly known as SWP. SWP provides regular withdrawals from invested mutual fund units and is useful for creating steady income, especially during retirement. Next is New Fund Offer, commonly called NFO. NFO is the first time launch of a new mutual fund scheme where investors can invest at an initial offer price. So, all these options support disciplined investing, better cash flow planning, and goal based financial management. Commodity markets are organized platforms where commodities such as gold, silver, crude oil, and agricultural products are traded. These markets allow buyers and sellers to trade commodities in a transparent and regulated manner. In the Indian context, commodity trading started in the 19th century, especially in agricultural commodities. Over a period of time, commodity markets have become an important part of the financial system. Currently, commodity markets in India are regulated by SEBI, which ensures transparency, investor protection, and proper functioning of exchanges. The two major recognized commodity exchanges in India are MCX, which mainly deals in metals and energy products, and NCDEX, which focuses on agricultural commodities. So, commodity markets provide price discovery, risk management, and investment opportunities for different types of investors. Every individual has different financial goals, so investment portfolios cannot be the same for everyone. Because of this, portfolios should always be customized according to personal requirements. Now, let us understand the important factors required for creating a unique investment portfolio. First is age and income level. Young investors can take more risk while senior investors usually prefer stability. Next is financial goals. Goals can be short term, medium term, or long term, and portfolio structure should match these goals. Another important factor is risk tolerance. Some investors are comfortable with market volatility while others prefer low risk investments. Next is investment time horizon. Longer time horizon allows higher equity exposure, whereas short term goals require safer instruments. Liquidity needs are also important. Investors should have easy access to funds in case of emergencies. Tax considerations play a key role in selecting suitable investment products to improve post tax returns. Finally, market conditions also influence portfolio decisions. Proper asset allocation among equity, debt, and other assets reduces risk and improves goal achievement. Mis-selling means selling financial products that are not suitable for the investor by hiding actual risks or by exaggerating expected returns. Mis-selling usually happens when the product is pushed only to earn commission without considering investor needs. Now, moving next to how mis-selling can be identified. One clear sign is unrealistic return promises. If returns look too high with no risk mentioned, it is a warning signal. Another sign is pressure selling, where investor is forced to take quick decisions without enough time to understand the product. Third sign is lack of product clarity, where features, risk, or charges are not properly explained. Now, moving next to how investors can protect themselves. Investors should first understand the product completely before investing. Important documents should be read carefully, especially terms, conditions, and risk factors. Investors should also check advisor credentials and avoid depending only on verbal promises. Finally, investments should always be matched with financial goals and risk profile. So, awareness and informed decision making are the best ways to avoid mis-selling of financial products. Gold investment includes different forms of investing in gold. First is physical gold, such as jewelry, coins, and bars, which is the most traditional form of gold investment in India. Next is gold ETFs, which are traded on stock exchanges and represent gold in electronic form. Another option is sovereign gold bonds, which are issued by the government and provide interest along with gold price appreciation. Gold investment also includes digital gold, where gold is bought and stored in digital form. Now, moving next to the role of gold in investment planning. Gold acts as a hedge against inflation, meaning it helps in protecting the value of money over time. It also protects investors during economic uncertainty and market volatility. Gold helps in portfolio diversification as its price often moves differently from equity and debt investments. However, one important limitation is that gold does not provide regular income like interest or dividends. So, gold is mainly used for stability and protection in an investment portfolio. Mutual funds collect money from a large number of investors and invest this pooled amount in diversified securities such as equity, debt, or hybrid instruments. These investments are managed by professional fund managers who have expertise in market analysis and portfolio management. The main benefit of mutual funds is diversification as money is invested across multiple securities, which helps in reducing risk. Mutual funds also offer high liquidity as investors can easily buy or redeem units at the prevailing net asset value. Another advantage is convenience because investment monitoring and record keeping are handled by the fund house. Mutual funds are highly suitable for small investors as they allow investment with relatively low amounts and provide access to professionally managed portfolios. Therefore, mutual funds serve as an efficient investment option for long term wealth creation and financial goal achievement. Systematic investment plan, commonly known as SIP, is a disciplined investment method where a fixed amount is invested at regular intervals, such as monthly or quarterly, in mutual fund schemes. SIP helps investors to invest consistently without worrying about daily market movements. One major benefit of SIP is rupee cost averaging because units are purchased at different market levels, which reduces the average cost over a period of time. Another important advantage is reduced market timing risk, as investment is spread across various market cycles instead of investing a lump sum at one time. SAPE also encourages a saving habit, as a fixed amount is automatically invested from income on a regular basis. Due to these features, SIP is highly suitable for long term wealth creation, especially for goals like education, retirement, and future financial security. Therefore, SIP is considered an ideal investment option for disciplined and goal oriented investors. Investment planning is a systematic process of identifying financial goals and selecting suitable investment options to achieve those goals in a planned and organized manner. The first step in investment planning is goal identification, where goals like education, marriage, retirement, and wealth creation are clearly defined. Moving next, risk assessment is done to understand the investor's risk taking capacity and risk tolerance level. Next is asset allocation, where money is distributed among different asset classes such as equity, debt, and gold to balance risk and return. After that, investment selection is carried out, where specific products like mutual funds, bonds, or deposits are chosen based on goals and risk profile. Finally, monitoring and review is required to track performance and make changes when needed due to market conditions or changes in personal goals. Therefore, investment planning ensures financial security and supports long term wealth creation in a disciplined and structured way. So, students, this was chapter 2, investment planning explained in a simple and exam oriented way. If you want to learn in more depth or join our video channel subscriptions on Telegram page channel, please feel free to join us. All details are mentioned in the description. Keep learning, keep growing, and all the best for your MBA exams. Thank you for watching.